So very good afternoon to you. Just a few updates. I withdrew the valuation spreadsheet from the study material in both track and the project workspace in Optima because I made some changes. So basically, your one spreadsheet is the entire project, So I have discussed the valuation from two sides. The first side is the market valuation, which we did last week during the classroom, if you remember. I took the example of GlaxoSmithKline, and then I discussed with you that how you can do the valuation with the stock market indicators, right? You get my point? I hope you remember, and I shared this YouTube video also, which was quite long, but it's good that it's long because then you know everything. Today, I will quickly revise that technique very quickly. And then I move on to valuation through the accounting numbers. Do you get my point? So we have done the valuation with the stock market indicators. And today we shall do the valuation with the help of the accounting numbers, the accounting data, so that you as a early stage corporate valuation experts, you are able to do the valuation from both techniques. I mean, you can evaluate a company with the accounting numbers, and you can also evaluate the company with the stock market data. So that would be quite useful. I try my best that I make it as simple as possible. I hope you know that when you are looking at the accounting numbers and the stock market number, there is a little bit change, there's a little bit different perspective in it. When you look at the accounting data, you believe in history, okay? Today, you dig the history and you make a future forecast. So the accounting data is essentially backward looking, or how to say it? Yeah, so it's more like a historic information. So you look back to analyze the accounting numbers. But when you are analyzing the stock market, you are forward looking. So your entire perspective is different, because the stock market going up and down is an indication of the company's future. So the stock market numbers are futuristic, whereas the accounting numbers are historic. But the fact remains that we can't say that the future is more important than the past. Past events, we learn a lot from them, and then based on that, we make some decision making. So that's why it's very important that you are equally good in the past and the future. So you are looking at historic numbers, and you also make some futuristic analysis, okay? So because we have done with the stock market, which I would be revising very quickly. So last time when we met, I think we took how many years? So we took about 20 years data, the stock price data of the dividends, right? So Sahar, please make sure that this screen is shared so that, so we have the dividends, and then based on that, we made some calculations. So we could find out that I aggregated the dividend for each year, and then we were calculating the dividend growth rate, at what rate the dividend is growing. And then finally, we were able to make some kind of average rate, that this is the rate at which the dividend is actually growing. So it was basically this. And then we made a forecast that because this is 2020 now, and it's I think we also discussed, and I can show you with this data that this is 2020, and 3 quarters, 1, 2, and 3 have elapsed, and the trend of the dividend is same as the last year. So I have a good reason to believe that if the 3 quarters, the dividend payout has been same, then it should not be a surprise that if the dividend in the last quarter is also the same. So I assume that the dividend will be 80 pounds in the overall for the year 2020. And I wrote a note here that since the dividend pattern is same as in 2019, so it is assumed that the dividend paid will be same as in 2019. So I took this figure, 80,000. And you can see that because it's 80 pounds and 80 pounds, so the rate of growth is basically 0. So there's no real increase in the rate of the dividend. But here, I make some kind of forecast that next year, it could be possible that the dividend grows at 5%. And why I chose 5%? Why I chose 5%? If you remember, if you want, I can go back to the website. We went to the Yahoo Finance, and then from there we went to GlaxoSmithKline's information, and we saw that what is the future forecast, the analyst forecast, that how much the company revenue will grow for the next year, and it was 5%. So we have a reason to believe that if the company's revenue grows at 5%, then why not dividend grows at 5%? So we made some assumption. Remember, we have to, in this valuation part, we have to do a lot of assumptions and lots of assessments, okay? We use a phrase in finance called educated guess. You make a lot of guesses, you make a lot of estimates, but as long as those estimates are reasonable and you can convince people that why you made this figure, why you picked this figure, why not that figure, you know, if you are able to justify it, it's fine, okay? Everybody does. So we always make some kind of estimates for the future. So I assume that your dividend will grow at 5% in 2021, and then the dividend would be 84 if you look at the rate of growth. And then the next year, 2022, the dividend would be 4%, 3%, 2%, because eventually, over the time, GlaxoSmithKline, like any other company, will feel the heat of this COVID-19. And the companies, they will bear this brunt, or they will face this music, not for 1 year, but for many years to come. And moreover, we don't know how long COVID will stay. So I wanted to sound myself as cautious, as pessimistic, as conservative as possible. I don't want to sound like any analyst who is very flamboyant. There's no point of being flamboyant in this situation. So I'm on purpose, I'm having this very conservative approach. So you will see that whenever I make estimate in the next spreadsheets, when it comes to revenue and profit, I'm conservative. So the figures I deliberately put low. And whenever it comes to cost and possible losses, I put more, so that I'm sounding as well prepared as possible. I want to have the pleasant surprise, but I don't want to have an unpleasant surprise. Like there is a saying that hope for the best and prepare for the worst. So when you hope that something good will happen. But when you are making preparation, you prepare as the worst will happen. Then you don't go wrong. So here I make an estimate that in the next 4 years, or rather 5 years, the dividend will grow. And in 2025, I assume that the dividend will be 1%. So you can see that this growth rate is reflected, and eventually, if this my conservative attitude turns true, then we can make an estimate that by 2025, the dividend which GlaxoSmithKline would pay would be about 92 pounds a year altogether. Remember, GlaxoSmithKline is paying dividend in 4 quarters. Some companies pay twice, some pay 3 times. I think it's a matter of their tradition. And this tradition doesn't change every year. So it stays for many years. I know when I saw 2000, 2001, 2002, during those years, GlaxoSmithKline used to pay dividend 3 times a year, 3 times. But for last many years now, over 10, 15 years, I guess, GlaxoSmithKline has been paying dividend every quarter. So it's like a, so, and it does, and you want, if you see it, you even would find that not only the month, look here, 2019, August, May, Feb, almost dates are same. You know, so the companies, the dividend is a very like a very ritualistic thing. It's very kind of ceremonial thing. So they don't change it much. And once you have this dividend growth rate, this is the rate, then eventually we start using the discounted cash flow method. Okay, and as you can see in the formula, I'm discounting the cash flow. Can you see it? I'm discounting the cash flow, which basically means that if the dividend grows at 5% and you get that 5% dividend at 5%, it becomes 84. This 84, the present value of this 84 is equal to 80 pounds. Do you know what I mean? We discount it. So basically the present value means in 2019 or 20, I'm sorry, 2020, the present value of dividend is 80 pounds, which will be 84 in 21. So you have a choice. Basically, you can ask the investor, hey, do you want 84 pounds next year? Or do you want 80.67 pounds now? So you are in a trade-off situation. So when we go for it, then we calculate for all the years, and then we find out basically, I'm sorry. So here, before I go to the final figure, so this is 21 next year, this is 22 the following year, 23, 24, and here 25. But when I go to 25, what I do, in 25, there'll be 2 cash flows. The one cash flow is that you get your dividend, and the second cash flow is that you also sell your stock. Do you know what I mean? You find or not? So there are 2 cash flows. In all other years, there is 1 cash flow. For example, in 2021, dividend. But in 2025, the cash flow is different looking. Do you know why? I want to ask you something. If I give you loan, I give you loan for 5 years. Next year, you will give me interest. And again, next year, you only give me what? Interest. But in the final year, you not only give me interest, but you also give me my principal amount back. So then the amount becomes big. All right. If I give you 1,000 euros, and let's say the rate of interest is 10%. So next year you give me 100 euros, then 100 euros, then 100 euros, then 100 euros. But in the final year, you give me 1,100 euros because you pay me interest plus the principal amount which I lent you. All right. So now here we want to estimate what would be the value of the stock price. And then we use here dividend discount model. Remember we discussed that the dividend discount model formula is you divide the dividend by the discount factor. You know the discount factor? In this case, the discount factor is changing 5%, 4%, yeah, minus the growth in dividend. So we use the rate of discount, and we use the rate of discount. We use the rate of discount R, and we also use the rate of growth in dividend. And you can see here, this is equal to AC3. What is AC3? AC3 is the dividend in the final year, yeah? AC3 is the dividend in the final year. And what do you divide with? You divide by D9. Now, what is D9? Well, D9 is the discount rate, 2.040. The discount rate is 2.040. The question is, where this 2.040 comes? Can you do one thing? Please remember this figure 2.0. I don't want to shuttle between different spreadsheets to confuse you. Please remember this figure. We are yet to find out where this 2.04 comes from. But remember 2.040. And this is what? This is the discount rate. And then what we do, we use it in the formula. And what is AC5? AC5 is 1%. Can you see? And what is AC5? 1%. This is the rate of growth of dividend in 2025. And when we put it back, we get 8913.29. This is the expected price of GlaxoSmithKline stock in which year? In 2025. But we want to find what is the present value of this. And then we discount it as usual, as before, at the rate of discount. But remember, we are yet to solve the mystery of 2.04, okay? Even though we have done it last time, but I still want to go again. We haven't? We have, but I'll do it again, don't worry. But remember this 2.040, this D9 cell, we yet to solve the mystery, but no worries. And then once we have this cash flow, then we make an estimate. So we are adding the cash inflow in 2020, in 21, in 22, 23, 24, 25, and we find out that this is ultimately the estimated stock price of, so if today the theoretical price of GlaxoSmithKline should be this. Look, 8464, so approximately 8465. This is the price of GlaxoSmithKline, which should be today. Be careful, timing is very important. This is the notional theoretical price, which should be today. But what is the price? When I saw last week, it was 1,510 pounds. So what does it mean? When the price should be X high, but the real price is Y below. What term will be used then? Undervalued. It means that according to the stock market data analysis, GlaxoSmithKline's share price, even though, now see what, if you ask somebody 1,500 stock price, 1,500 something, people would say, oh, great. But that doesn't mean that the stock price is comparatively up. So never make a decision based on the absolute size of the stock price. So even though 1,510 sounds really high price, but this is below what it should be. This is the price what should be. But this is the price what is. And here I make this logical statement that if X10 is below X9, then it's undervalued, else overvalued. So you see this logical statement, and that shows that the stock is undervalued. Yeah? Any question, doubts about it? So it's just we carry on the calculation. We're just basically applying the simple arithmetic, the rate of growth. The only thing which I haven't told you yet, that where this discount factor come from, which I will tell you soon where it comes from. But do you understand this notion or not? That this is 8464 something should be the price, but the price is below than what it should be. So basically, the equilibrium price is almost 5 times, more than 5 times more based on the estimate. So GlaxoSmithKline is underperforming stock. If you are a value-based investor and you have a strong reason to believe that this underperformance will not last very long, eventually the market imperfection would cure, would be removed, and the trend would be more towards the average, the equilibrium price. Do you know, we believe in the law of average, don't we? So we think that the idea is that, maybe I draw it here because otherwise students can't follow me what I'm trying to do. Okay, so I'm sharing this another. So the idea is that the idea is that this is the equilibrium price, the straight line, which in this case is about 8464, if I'm not wrong. Can I, no? Well, I can do it like, no, I can't do it. Eraser. Yeah. What happened? Ah, it goes off. So if I make a text, so this is 8464. I don't remember which exactly, but it's 846. This is the equilibrium price. And then the price is basically, the price is basically moving like this. But we believe that eventually this imperfection will go up, will be over, and if not 8464, at least the price will show upward tendency, because we believe that the average is like a magnet. It attracts. If something is up, it tends to go down, and if something is down, it tends to go up. This is the law of average. You get my point? Because the real price is something about 1,510. The conceptual price is 8464. So even though in your lifetime it doesn't touch and become equal to 8464, but one thing is for sure, one thing is not sure but highly expected, that eventually the stock price will go up if you are a value-based investor. So you should either buy it or if you should hold it. If you don't have it, then have it, buy it, and if you have it, don't sell it yet, because eventually the price will go up. That's my notion, idea about the average. Right. Now I discuss with you where this 2.04, where this rate of discount come from. That's very important. And then I go to the next sheet. I took the stock market data of GlaxoSmithKline from September 11, 2020, and we went as far as 2001. So we took the data for 20 years, and then we calculated, we took the GlaxoSmithKline's closing price. Always take closing price of the day, all right? And then we calculated the return, which is equal to today's price. First of all, is equal to, put the bracket. If you don't use the bracket, believe me, this your complete big error, not an error, but a blunder, okay? So put the brackets carefully, is equal to, bracket starts, the current price minus the previous day's price, bracket close, divide by the previous day price. And then we get this everyday GlaxoSmithKline return. Same way, I took the index. If you are in Finland, then I think this Nordic OMX index is taken. If you are a French company, you take CSE. If you take some German company, you take DAX. If you are in US, you take NYSE index or S&P. In Britain, it's a FTSE, FTSE. Okay, and I took the FTSE 100 index, which means the top 100 companies, and GlaxoSmithKline is definitely one of those top 100 companies. And I took the closing index value as well. And then, like the GlaxoSmithKline return, we can also calculate the index return. But the thing is that we only get the average daily return of GlaxoSmithKline. So I had 5,160 trading days in 20 years. And if you divide 5,160 by 250, because normally as a rule of thumb, if you divide 5,160 by 20, you will find that it's almost 250, because we have nearly 250 trading days in a year, because 365 days, and then we have 104 weekends. Usually, sometimes you have 53 weekends, or 53 weeks also, certain time, because it depends upon which day the new year starts. So if you take away them, and if you take some holidays, some off day, sometimes the stock exchange is too lean and they close it, they don't open it. Anyways, it's about 250 on an average working days. And when we calculate it, it comes out to be daily, every day, on an average, for the past 20 years, the GlaxoSmithKline stock return has been increasing at 0.0061%. And when you annualize it, because we always show percentages in yearly basis, it comes to be 2.2343%, so which is fine. This is the annual increase. So the GlaxoSmithKline stock is increasing. Return, not stock, I should be careful. Return is growing at 2.23% a year for the last 20 years. And then you compare the index return also. And you see that in comparison to the GlaxoSmithKline, the index is growing on daily basis at this. And when you analyze it, it comes to be this. So when you see the return, no wonder GlaxoSmithKline is undervalued in comparison to the rest of the market. Yeah, make sense? And then I get some more data from the risk-free rate on an average has been 2% in Britain, and I got this data from this website, tradingeconomics.com, very reliable source. 2%. I double-checked it with the what is called the Bank of England's website also. So it's approximately 2%. So 2%, the risk-free rate. On risk-free rate is basically the 10-year bond rate. So this is 2%. Then I calculate, I'll come to this 2.0. Remember this 2.04? Do you remember 2.04? This is exactly 2.04, which I'm talking about, but I will show this calculation a bit later. We get some data from the interest expenses. May I know, where do you get the data from the interest expenses? Where does it come from? What is the source of this information? Income statement, interest expenses. Sometimes you call it finance cost as well. Total debt, we get from the liability side of GlaxoSmithKline. Total equity, we get from the same that side, and then the profit before tax and the corporate tax. And here I calculate the effective tax rate. So it means that when I divide, if you Google, never take the headline tax rate. The headline tax rate is, if I Google now, corporate tax rate in UK, it may not be same. Remember, not every company pays the headline tax rate. So you need to find the actual original tax rate which company is paying. And this is done like this. You divide the corporate tax amount in millions, divide by profit before tax in million. Both are in million pounds. And we find that in 2019, the company is paying 15.32% as a tax, the corporate tax. And then we can calculate the debt rate. So debt makes 50% and equity makes 40% of the company. And then we calculate the cost of debt also, which is the amount of interest you pay divided by the debt. It's very simple. If you borrow, can I ask you one thing? If I borrow 1,000 euros from you and I pay you 100% interest, sorry, if I borrow 1,000 euros from you and I give you 100 euros as interest after 1 year, what is the rate of interest? 10%, exactly. So this is what we calculate here. So you know the amount of interest GlaxoSmithKline is paying, and you divide by the total debt. That will give you exactly the interest rate which GlaxoSmithKline has been paying. But before I come to this, now I calculate the beta. Beta is a measure of responsiveness. So basically, this is calculated as a slope. So this is calculated like this, that what is the responsiveness of the company's stock return to the index return. And if I have to draw beta, it should look like this. Well, I have no harm. There's no harm in drawing. I can share screen once again with you, the whiteboard. So if I want to draw beta, if I take for example, I take GlaxoSmithKline, can I call it GSK? GSK is the code for this. So GSK return. And if I have here FTSE 100 return, and then I draw a line, like a straight line. The line is like this. Okay. So basically it shows when we have 0.12, it shows that when there's 1% increase in the whole market, the GSK return increased by 0.12%. Make sense? So that shows beta. That if the beta is equal to 0.12, GSK beta is 0.12. It's always a coefficient. Never write beta in percentage, which means that when market goes up or down by 1%, the GSK stock return goes up or down, it works both ways by 0.12%. Hence, beta shows sensitivity slash responsiveness of a company's stock return with the relevant index return. Make sense? Yeah? How does it look now? Make sense? Okay. Now we go back to our spreadsheet. And we have beta, you know how to calculate now and what does it mean? So I don't have to explain it. This 2%, I took it, so there's no formula. I took it from the trading economics website. It's a very good page. And then I calculate our famous capital asset pricing model, which is equal to Q8. Q8 is the risk-free rate plus Q5, which is the beta, multiply, bracket starts, annualized market return, which is 2.322 V16 minus risk-free rate. And when I click OK, it gives me 2.039 or 2.04%. Remember, we were talking about 2.04% in the previous spreadsheet. Now, 2.04% shows that if I'm the potential investor of GlaxoSmithKline, the minimum return which I must get, I won't say should get, I will say must get, which I must get from GlaxoSmithKline is 2.04%. Let me make it to 2 decimal places, otherwise it's a bit tricky. Yeah, 2.04%. The minimum return which I must get from GlaxoSmithKline is 2.04, and if my expected return is 2.04, is less than 2.04, then I must not invest in this company at all. So this sets a floor. You know the hurdle rate? Have you seen the hurdle race? It doesn't matter how much you jump over the hurdle, you must not be below the hurdle, because then you hit your ankle, you hurt your foot, and you can't run. So this is a kind of benchmark or bottom line which I must get. So 2.04 is something I must get from GlaxoSmithKline. Otherwise, if my actual return is less than 2.04%, then it's not a good job. And you can see now, you can compare. Look, have a look at this, by the way. Look, it's so interesting. Have a look at this. Can you see what is this? This is the actual return of GlaxoSmithKline. And this is the hurdle return of GlaxoSmithKline. So it means that even though, look, hey, we got so many great observation. When you compare GlaxoSmithKline's actual performance with the market performance, when you compare GlaxoSmithKline's actual performance with the market performance, did GlaxoSmithKline underperform or overperform? But when you expect GlaxoSmithKline with itself, CAPM shows what you are minimum you must be capable of. And the actual return is more. So what is minimum expected from CAPM is, from GlaxoSmithKline is 2.04%. And what CAPM is producing, generating is 2.23%. So basically, GlaxoSmithKline disappoints investor when we compare with the rest of the market. But actually, GlaxoSmithKline has overperformed against its own expectations. Do you know this notion or not? For example, when I have the exam, when I put some test, it could be possible that some students got grades more than average, some get less than average. But the question is that even though you get grades less than average, let's say you get 2 grades and the class average is 3. The index is 3, but your average is 2. I mean, you got 2. But I was actually expecting 1 from you, but you got 2. So in a way, you overperformed. That is what GlaxoSmithKline has done. GlaxoSmithKline doesn't do well in comparison to the rest of the market, but GlaxoSmithKline does pretty good job in comparison to its own expectations, which are the minimum. And then this 2.04 is the same 2.04 which is here. Yeah, all goody. This 2.04 is the same. So this is the minimum. So this is the rate of discount we use for this calculation. When I use the rate of discount, this 2.04, which come from CAPM, I think I wrote a note here as well. This is derived through CAPM or WSEC. Okay, well, let's first talk about CAPM. So this come from CAPM, yeah? When you look at this discount rate, 2.04, and remember this we have been using here in the dividend discount formula here, yeah? This is where we use the discount rate. So, yeah. I want to ask you something. What is the problem if I use this discount rate as CAPM discount rate? What is the problem with this? What is not so good about it? I have used it and I got the values of the stock, and according to this 2.04, when I use it as a discount rate, it comes to that the theoretical price of CAPM should be this, whereas the actual price is this, so the stock is undervalued. But the problem is that in this calculation, I have used this discount rate. What is wrong with this? What is wrong with this 2.04%? Students following online, you can write in comments or you can speak out, no problem. But what is the main limitation of this CAPM?
It doesn't consider that, right?
Fantastic, fantastic. Because if you see this 2.04, it only comes from the stock market, it's the equity market. Where is debt? Come on, look at GSK. 57% of the total capital is debt, and I'm plainly ignoring it. That's not good. So what I do in order to get rid of this limitation, I reconsider, should I revise my discount rate? And for this, I calculate weighted average cost of capital, which includes debt and equity both. So what we do, we multiply R27. R27 is the proportion of equity, which is 42 something. We multiply it with Q11. Q11 is your ROE according to capital asset pricing model. Plus, we have R26, which is the share of debt, which is 57, almost 58%. And we multiply it with 1 minus R24, and R1 minus R24, what is this 24? This 24 is the effective tax rate. And then we multiply with R29, which is the cost of debt. Okay, the question is that, why do we bring this 1 minus R24 thing? What is that? Why do we bring it in? So why don't we simply find the weighted average of share of debt multiplied by cost of debt plus share of equity times multiplied by cost of equity? Why did this tax thing come in between? The idea is that, anybody has a comment to make? The idea is that your debt is, your interest payments are tax exempted. Do you know that when you look at the financial statements of a company, you should, we will see today, because after some stage, I would like to work with you as a workshop that you guys work on these two companies, AL. You will see that when you pay interest before and you pay capital. Company has two sources of finance, debt and equity. Debt holders get interest, equity holders get dividend, right? But dividend is paid after tax is paid, but interest is paid before tax is paid. So interest is paid. So basically your interest payments are tax subsidized. So therefore, even if the cost of debt is 3.619%, but actually you don't pay 3.619, you are paying, let me calculate exactly how much you pay effectively. 1 minus, where is cost? This one here. So yeah, so basically you are effectively so even though the cost of debt is overall 3.6169, but you get some exemption from the income tax, and ultimately you pay 3.06. So this is 3.06, which comes here in the weighted average cost of capital. So then it becomes overall weighted average cost of capital 2.6316. And here I write a note that you may try this calculation with WACC discount rate also instead of CAPM return on equity. So you can also try with this. I left this open for you. The question is that when and why should we use CAPM return as a discount rate or WACC as a discount rate? My personal belief is that if a company is having less debt in its balance sheet, then you can live with CAPM ROE rate as a discount rate. But if a company has sizable proportion of debt in its balance sheet, then you should take WACC. Okay, and I haven't seen Finnair and KLM's balance sheet yet, but I have a strong hunch that because these are tangible assets-based companies, they're not IT, they're not service providers, they are the actual, they use a lot of physical assets. Look, the aircraft so expensive, both companies. So I have a strong reason to believe that both companies have lots of debt as well. So in that case, I recommend you that you should use weighted average cost of capital. And as a matter of fact, in the third spreadsheet, which is another method, I used WACC as a weighted average cost of capital, as a discount rate for calculating, for making calculation for GlaxoSmithKline. Now I start. Yeah, So the second and the last method of valuation is called free cash flow method. And we also call it enterprise value method, that how the enterprise is getting valued. This is a very easy technique, but the only hiccup is that you have to be a bit of patient because you need to look at some past annual reports of the company. Usually, if you look at the income statement, I don't know why, but if you look at the income statement of company, it's normally for 3 years. Yeah, 3 years. But if you look at the balance sheet, it's for 2 years. So it means if you look at the balance, if you look at the financial statement of this year, 2019, you can get the data for 2018 at least. And then you look at 17, you get for the 16 also, 15, you get. So you don't, it depends on you. Like I went quite much in the past. I went from 2019 to 2013. So essentially, 7 years, but even if you can go 5 years, it's okay. So basically, I could have done my calculation starting from 2015, basically. Because 15 means 15, 16, 17, 18, 95 years. 5 years time window is pretty good, but I took 7 years. So it's your wish if you want to take 7 years. Honestly, when you start collecting the data, it's not a big deal. It's after 1 or 2 reports, you become through. You become very, you know what to do, what not to do. So we call it free cash flow method. And as I said, this is the last method. Now what I do here, my starting point is that, once again, and I made all the calculation on 22nd and 23rd of November. So I took the price of 23rd of November, which is 1510. Same price which we saw in the previous spreadsheet. Remember? It was 1510. You can see it here. This one, yeah. So I took the same price here as well. Now here, and one more thing, you need to know that how many shares are outstanding. How many shares the company has in the market. And I came to know from the company's annual report that there are many sources of knowing the shares. I think you can easily get from the last, if you go at the bottom of the income statement, you will see the number of shares outstanding. And it comes to be about 5 billion shares. So if I translate them, it's 5,016 million, which means basically 5 billion shares. Yeah. Is it 5 billion? If you look at these numbers, is it 5 billion, you think? Yeah. And I shared the screen with you. Share once again. Right. So the first thing we need to calculate sorry for this interruption, and I hope I'm sharing the right screen with you, but I can do it now if I'm not, so that you can see what I'm doing. So the first thing you need to know is that how many shares are there, outstanding shares, and we double check that these are the number of shares in circulation, and the current price is this. And then what we do, the first information I need to extract is that I need to know the revenue in million pounds, and because the income statement includes in million pounds, so I took data from 2013 and I went up to 2019. I don't have the data for 2020 yet, but I know that the revenue is increasing at this rate. So the 2014 minus 2013, like you calculate the stock return basically. And we find out that the average revenue increase has been 8.69 in the past. But look, so the average, we don't know, but we can calculate. But I strongly recommend you that the average can be sometimes tricky, because if you have last few years, 5, 6, 7 years, normal year, and you find the average, and you have a strong reason to believe that in the near future is also going to be the normal, then you can use the average. But you know what? We are in 2020. Can I ask you, is it a normal year? Is it a normal year? Of course not. So then the average, which is you have calculated based on the past, may not be a truly representative. And I become, as I said, that in this entire calculation, I'll be very conservative, which means that when it comes to the revenue, I would be making my forecast as moderate as possible. But when it comes to the revenue and the costs, when it comes to the cost and the losses, I would be putting the number up so that I become as realistic as possible. So I want to prepare for the worst. Okay. So here I assume that the revenue in 2020 will increase at 3%. And then for the next year, I make a very pessimistic forecast. Now here you have to make a forecast by yourself. You need to make some assessment by yourself. Okay. Yeah. So I make an estimate that the revenue increase 3%, 2%. I could have taken average. If I'm living in a normal time period, if 2020 is not affected by COVID, then you know what? This number for 2020, I could have simply taken the average of the previous years. Look what I would have done. Pay attention to the screen. If 2020 was not a COVID year, I could have done like this, average of the past years. Something like this. But I chose 3%, even though 3% is not far away from my estimate, but I still chose 3%. So like this. And then we have the EBITDA, the earnings before interest, tax, depreciation, and amortization. And this number is 8442. This is the real data, which is based on my observations. But after 2019, this is an estimate. And this estimate is based on my forecast that the EBITDA will grow at 5% next year. And then I try to be as low as possible so that I assume that the EBITDA, the operating profit, will grow at 5%, 4%, 3%, 2%, and 1%. And based on them, I get these numbers. So my last real year is 2019. And based on that, I make a forecast for the future. So once I have 2020, I can calculate for 2021. And once I have 2021, I can make an estimate for 2022. But if you see, you will notice that I've been very conservative in terms of my profit and revenue forecast. If the actual profit is up after 3 years, 4 years, it's a good news for me, but I don't want to hear the bad news. So I put my estimates as low as possible. I repeat, if there was no COVID this year, I could have taken simply the average of the previous years and then continued with. And if even if I would have a reason to believe that the future is going to be bright, then 2020 and 2021 would have been higher rate. 22 even higher, 23 even higher, 24 highest perhaps. If I have a good reason to believe that the world economy is going to increase, but I have no logic, I have no argument to believe that in the next 4 or 5 years, things will be very high suddenly. At least if they will not go too bad, but they will remain pretty stable. But in my calculation, I want to sound as conservative as possible. I'm repeating this word time and again. I want to be very conservative. And then I make a calculation of the growth rate, which is again based on the previous year, the current year, minus previous year, brackets closed, divided by the previous year. And thus I calculate all these numbers, and the formulas, the way I calculate them, they are very much given here. So there is nothing which you don't understand, okay? So all these data I'm taking. And if you look at the heading, these are all numbers which highlight companies' operating problem, not problem, which highlight companies' operating performance. Okay, maybe I'm talking too much about problems today. So this is all about the company's operating performance data. So all these numbers, they are showing how well the company is operating. You know that the total revenue you get. Do you know the hierarchy of profits? First, you have total revenue, then you minus your operating cost, then you get EBITDA, gross operating profit, earnings before interest, tax, depreciation, and amortization. And from that, you minus depreciation and amortization, and you get EBIT, which is earnings before interest and tax. And that is your net operating profit. From EBIT, you minus your finance cost, basically your interest expenses. And then you get gross profit, or the profit before tax, or the earnings before tax. And then from that, you minus the corporate tax you pay. And then you're left with the net profit, or the profit after tax, or some accountants call them earnings after tax. So this is, there's a hierarchy of profits. And then guess what I do? I have got cash figures for last 6 years. All right. And then I make an average estimate that what is the rate of growth of cash. And I find that the cash growth average has been -1%. So I make an estimate that the companies would be cash starved in the future. You know what I mean? Do you think that the companies would have a lot of cash in the future? When there's a recession, when there's a bad time, the cash shrinks. The cash figures goes down because people are very scared of paying you cash. So I made an estimate that in 2020, 21, 2, 3, 4, 5, there is the cash of the company is going to shrink. And based on that, we make an estimate that this is the, so I have cash of 2019 plus the rate of growth, 1 plus this, and that would show that the cash figure is going to shrink for 2021. This would be the cash figure. So I'm just using the rate of increase, how we calculate the rate of growth, basically. It can be growth or it can be, you know, other way around. And then we have the accounts receivable. From 2013 up to 2019, I have the actual data of accounts receivable. What are accounts receivable? May I know? What are accounts receivable? Huh?
Whatever money from the people that you have.
Yeah, if I sell something to you and I sell something for 100 euros, right? You pay me cash, 20 euros, let's say. My cash up by 20, but my accounts receivable are 80. It means I own a claim on you. You owe me a claim, yeah? and I own a claim on you. You are basically going to pay me. So that is, do you think that in the future, GlaxoSmithKline will have more business on credit or cash? Because then you can expect that the customer of GlaxoSmithKline would rather not pay cash, but more they will ask for credit. And maybe the companies are basically blackmailed, or they're compelled to satisfy the customers their wishes, because if they deny, then the customer can go to AstraZeneca or some other companies, because Glaxo has many competitors also. So in the bad times, the customers become even more powerful, because if they say, no, I won't pay you cash, then what can you do? If you insist, they will change the supplier. Remember? And I'm not talking about the customer who buy GlaxoSmithKline medicine from the store, from the apteki, from pharmacy. No, I'm talking about the big, the big wholesale customers. Yeah. So I make an estimate that the GlaxoSmithKline's receivables, the accounts receivable would increase. And you can see here the ratio, this 41 row. Oh, sorry. What I've done. So the accounts receivable last year were 2,000. I have to calculate again. Multiply by 1 plus, and the rate of growth of receivable is 41 row. So it's this one, yeah. So I would assume that in the years to come, account receivable will grow at first 5%, then 6%, then 8%, so that by the time it's 2024, the accounts receivable are increasing at 15%. In the bad times, your customers don't pay you, and this way I get the data of all these numbers. How about inventories? Do your inventories increase or decrease when it's a tough time ahead? Think about it. Inventory is your current asset, yeah? You keep it in your stock. Do you increase inventory when the things are bad, or do you want to have less inventories? Or do they increase? Not, it doesn't matter you wish or you don't wish. What do you think happens to inventory? You want them empty?
So therefore, you can't step in part-time.
Yeah, and my assumption is that the inventory growth rate is actually going down, yeah? If you look at the row 42, you see that the inventories are going down. The company wants to maintain less inventories. Because see what? If I'm hopeful that the business would flourish in the future, then I would keep more raw material in my stocks, won't I? But if I'm pessimist that business is going down, do I still need to maintain a lot of inventories? That's my argument. You can counter argue with me that, hey, what if people don't buy things? Then you're left with no choice, but the inventory would stay. But because it's a pharmaceutical industry, they can't keep that raw material for a long time because it expired. You know, would you like to make medicine with the raw material which is expired? So the medicine is expired before it's manufactured, basically. So my argument is that GlaxoSmithKline, all else being equal, will maintain a lower inventory. But for example, if you are an aircraft company, then you are not under so much of pressure in comparison, because the parts, the tools, the equipment, the spare parts, or some other things which are about the airline thing. You have some spare seats. You know what? When you have the airline, you have some certain extra seats, which, for example, you can replace. Your engineer can replace whenever it wishes to. You can still keep them. So the way you treat the inventory of airline company, but for the GlaxoSmith client, I'm sure that they don't want to keep the expired raw material in the stock. In the worst scenario, they will just destroy it. So the inventory level would be low. The prepaid expenses. The prepaid expense, what is prepaid expense, by the way? When you pay something in advance. This is the month of September. You live in your apartment and you think that you'll be traveling abroad for next 2 months, and you actually pay the rent in advance. You pay already, yeah? Is it your asset or liability? If you see from this point of view, when you pay advance rent of 2 months to Coas, is it your asset or liability? Huh? Your liability or your asset? Your liability. If you don't pay me rent for last 2 months, then it's a liability. Isn't? You have given somebody advance money. It's your claim on that fellow. That fellow owes money to you. If you have traveled abroad and you have not informed Coas and you are absent for 2 months, they are writing you letters, emails, you are not there to pay, then it's your liability. They can even charge interest on you, and in the worst scenario, they can throw your stuff out of the apartment. Are you getting the point? When you prepay means you pay something which you haven't used the service. If I pay rent for January next year, it means I haven't got the service yet, but I paid rent already. It's my claim on them. It's their liability, my asset. So the prepaid expense, try to understand, see from this point of view. You want to buy something from me and you will buy it tomorrow. Ideally, you should buy it tomorrow and then make payment. But you made me payment already today and say, Shab, I'll come to you tomorrow and then I'll pick up my stuff, but take money right now. Do you prepay me? Is it your asset? No, not because I say that. Have I ever sounded like a dictator? Yeah. And imagine a situation. You buy something from me today. You take the delivery and you say, I'll pay you after 7 days. Is it your liability? Do you know the meaning of asset and liability? Asset is what you own upon somebody, or is a claim, and liability is when you owe something. When we borrow from the bank, this is a liability. But when you have the money with the bank, it's your asset. It's your asset, bank's liability, because bank eventually has to give this money back to you. So think it this way. And then there is accrued income. Accrued income, if you don't know, let me explain it to you. That accrued income is that income which has emerged, but you haven't received it. Let's say I have some stocks. I have some shares of Finnair. And today is 29th of September. Finnair has declared yesterday on 28th of September that everybody who owns 1 share of Finnair will get €2 of dividend. And let's say I have 100 shares of Finnair. How much dividend I should get? 200. So it means that I should call it my income, should I? But Finnair says, Shab, don't worry, we'll pay you. We owe you €200, but we will make payment on 15th of October. So even though my income is born today, my income has taken birth today, or yesterday, but I will not get it until 15th of October. This is my income, which is born, but I haven't seen it yet. Is it my asset or liability? It's a question to you. Is it my asset or my liability? My asset, because it's my claim. Finnair owes me 200 euros. Yeah, that's called accrued income. And what about accounts payable? Okay, but we haven't cleared about it. The prepaid expense in the bad times, will you pay more? Will you make more prepaid expense if you have to make? When you already have less money in your pocket, will you pay more money in advance to rent, to Quas? So it means that I have a strong reason to believe that the prepaid expenses in the future will go down, which is here. Prepaid expense, so it's 32 row. So I have a good reason to believe that the prepaid expenses, but yeah, I have taken more. Don't know why. Yeah, maybe I should reduce it because in the bad times, your prepaid expenses go down. Yeah, it's quite logical. You can please don't just listen to me or don't abide by what I'm saying. See the logic. The prepaid expenses go down. So 316 is the actual, so I'm going to reduce it now to 300. Let's say 280. Sorry, 275, 270, and let's say 265. So I have a reason to believe that my prepaid expenses will go down. 32, yeah. How about the accrued income? Does it increase during the session, the bad times, or does it decrease? Accrued income. Like remember the example I gave you, Finnair declared dividend and they need to pay me 200 euros, but they haven't paid me yet. Will this increase or decrease during the session? The accrued income. The income is born, but you haven't got it yet.
I think it will increase.
Excellent. It will increase because the companies who are going to pay me, they will try and delay the payment because if I have cash shortage, they also have cash shortage. So they want to delay the payments. You know, in the good times, you pay off your liabilities faster, but in the bad time, you want to delay it because they also lack cash. So very well said. I can assume that the accrued income will increase. This is row 33, which is true. I assume that the accrued income is increasing. So here I was more logical. What about accounts payable? First of all, tell me what is accounts payable, and secondly, what trend you see in accounts payable. But what are accounts payable? Yeah, accounts receivable is something which you have a claim upon somebody, like your customer haven't paid you yet, and accounts payable is that you haven't paid to your suppliers. You get my point? I sell furniture. You are my customers. You buy furniture from me. You don't pay me yet. This is my accounts receivable, but I haven't paid the guy who supplied me wood and the paint and all these things. He's my supplier, so he's my accounts payable. In the bad times, as you said, accounts payable also are likely to increase. So I assume that this is row 34, that in the coming time, the accounts payable will increase, and I think I was quite right. I got logical. What about the accrued expenses? The accrued expense is opposite to accrued income. Accrued expenses, the expense which is born, but you haven't paid yet. Like for example, I received an invoice from Quas that my rent is due and I need to pay tomorrow, but I don't pay it yet. I try not to pay. I try to delay as much as possible. That is called accrued expense. What do you think? Will it increase or decrease in bad times? Increase, because you want to delay the payments, right? And row 35, we see the tendency. Yeah, it's increasing. Accounts payable are more about the main business you are in. You get my point? Let's say I have a factory where I make furniture. My main business is to make furniture, tables, chairs. My main supplies are wood, raw material, etc., paint, etc. Okay, I don't pay money to my supplier. This is my accounts payable. But the building where I work is rented property. Now, rent is an additional expense, not my operating expense, right? Then this would be rather accrued expense. Okay. Same way, the accrued accounts receivable are your customer who buy main thing from you, but the accrued income is something extra. Like for example, you own an apartment. I run this factory making furniture, but I also own an apartment and I have my tenants living there. They haven't paid me rent yet. Then it's my accrued income. I will not call them accounts payable because I'm not into property business. Yeah, so make sense? Yeah. So you need to know that which is your main operation and which is additional, supplementary. Okay, so by doing so, we are able to make some of the numbers. For example, the debt will increase. I hope so, because people want to borrow more because they're scared. The gross capex, the capital expenditure will go down, assets will go down, liabilities will go up. So by doing so, we can complete this spreadsheet. And here you can see that we have the total revenue once again. This number is before. We have the EBITDA as before. We have the EBIT as before. The finance cost is definitely the difference between, we have the gross profit, we have the tax, and we have the net profit as well. So all these numbers, they come. And we also have debt. So all these numbers, they were existing in the previous section also. And then we make some estimates. And based on that, you can see here that we are able to calculate this final figure, which is called unlevered cash flow. Unlevered cash flow. And you can see that for all the years, we are able to calculate unlevered cash flow. But if you look at the cash flow, I want to ask you something. Look at this number 2445, and this is row 71. Or let me see this one actually, because then it's easy to see. Is inventory your asset? Is inventory your asset or liability? Asset. When your asset increases, it should be a good thing, isn't it? But guess what? I put minus sign outside. May I know why? Now, if it is a rate, it should be divided also, but nothing is divided. Give me one give me one logical reason. When your assets increase, what happens to your cash? When your assets increase, what happens to your cash flow? Does your cash flow increases or decreases? Huh? When your assets increase, your cash flow decreases. If I buy a table or a chair, does my cash flow increase or decrease? Exactly. This is why when your asset increase, I put negative sign outside. So when the assets increase, your cash flow decrease. So that's why I put minus sign outside, because I want to see if my cash flow is going up or down. When your assets decrease, your cash flow increases or decreases? When your assets decrease, does your cash flow increase or decrease? Increase. For example, I have this table, my asset. If I sell it, I get cash. So my cash flow goes up. Is it logical? Now, if my liability increases, does my cash flow increase or decrease? If my liability increases, does my cash flow increase or decrease? Increase. If my liability increases, imagine I borrow from Nordea Bank. It's my liability, isn't it? But what they do, they transfer cash to my bank account. Or, okay, forget about bank. I borrow this whiteboard, this flip chart, but I don't pay to the seller. Is it my liability? I buy it, but I don't pay. I don't make a payment. It's my liability going up. But what happens? I haven't given cash to him. So my cash. So had I bought it on cash, my cash balance could have gone down. Yeah. But if I don't pay cash, my liability increases, but my cash also increases, because cash remains in my bank account then, or in my wallet. But what about if my liability goes down? My cash increases or decreases? If my liability goes down, my cash decreases. For example, I have borrowed from Nordea last year. I want to pay them today. My liability down, but I also lose cash. This you need to keep in mind. This is why whenever there is increase in asset or decrease in liability, I put already a minus sign outside. So whenever there is a change in my assets, I put minus sign outside, but whenever there is a change in my liability, I don't put minus sign outside. Okay? So you have to be very careful in understanding that when you, because economics is two-way traffic. When you buy something, you pay something. At the moment, I'm only looking at the impact on the cash flow. And when I do this way, I get my cash flows for each year. Okay? Cash flow for 2020, 21, sorry. Yeah, 20. Then cash flow for 21, cash flow for 22, cash flow for 23, and cash flow for 24. Cash flow for 24. And then guess what? I calculate my discounted cash flows. Look at the screen. I calculate my discounted cash flows. And the discount I'm using is 2.63%. If you look, the cash flow, the discount rate I'm using is 2.63. And when I click the formula of 2.63, it doesn't give me any formula. Now my question is, where does this discount rate come from? Why am I using 2.63? Have you seen 2.63 before in today's lecture? Have you seen 2.63 anywhere else? Sorry? Fantastic. This was your weighted average cost of capital. So if you go to the middle spreadsheet, you will find out this is 2.63. 2.63, which was your weighted average cost of capital. And before I think we went to the break or something, I mentioned that for a company which has lots of debt, I would rather not use CAPM alone. Then I would be using the discount rate as weighted average cost of capital because, sorry, you have a question, something? So this is the 2.63. The weighted average cost of capital, which I'm using here. So that's why this is the 2.63, which maybe I should have put a note here that this is the WACC, and then we calculate the weighted average cost of capital. After we have it, we calculate the discounted cash flows. So a cash flow which you get 3861 in the year 2020 is worth 3762 in the year 2019. And the cash flow which you get as 7557 in 2024 is worth 6636 in 2019, because 2019 I'm using as a base year, even though in reality we are in 2020, but I pretend that 2020 is not complete yet. So please be careful about it. And then we have this long-term growth rate. You know the long-term growth rate? That in the final year, our revenue grows at 1%. Remember in the very beginning, this is M14 I took. And then 2.63 comes again. And then we can make an estimate that if you are in year 24, what would be the cash flow for the next year? And when we make all these values, we find out that the present value of the entire cash flow is 360,000 something million pounds. And then we also know that our share price has been 1510. And we today, after we have a discussion, we check that these are the number of shares GSK has, the cost of debt, the tax rate, the after-tax cost, the cost of equity. So 2.04, remember 2.04? 2.04 is this one, which was our the CAPM rate of return. So all these numbers, they have some reasoning. The debt is this much, equity is this much, and we end up calculating 2.63, which is the same weighted average cost of capital. And then very importantly, we make a calculation of the enterprise value, which is equal to B87 and B79. B87, you know that the B87 is your present value of the terminal value, and the B79 was your sum of all the free cash flows. This is the formula, and when we have it, it comes to be the enterprise value. Enterprise value is a sum of your all the free cash flows which you get and the present value of the company, enterprise. And then you minus debt. If you have no debt, what you left is the equity. So the equity is your worth 367,000 million, which is basically, can I call it how many billion? I don't know, let's call it million. I don't want to confuse myself between millions and billions. And we know that we have the number of shares, this much. And then we find out that the value of each share is basically 68. So the present value today of the GlaxoSmithKline's share price in 2024 comes out to be 68, 69, 68 pounds. And when you compare this price with the market price, which is 1510, we can make a judgment that the equity price of, GlaxoSmithKline is undervalued. Now, we applied two techniques. In the one technique, the stock market data is more prominent. And we got the result that the GlaxoSmithKline stock price is undervalued. And then we apply another technique, which is more of the accounting, historic information. And that also says the undervalued. So overall, we have two alternative techniques. Both, one is historic, this one, and the other one is futuristic, the previous one. But both are having one common conclusion, that GlaxoSmithKline stock is undervalued. This calculation, because I was explaining all the steps, I strongly recommend you to go through this spreadsheet by yourself and go through it as soon as possible. And you can also listen to the recording and try to make some connection between the two, so that you are able to understand this concept soonish. One thing I can assure you, that when you start doing it by yourself, you will learn it better, because there are some technicalities in the calculation. So please go through it, yeah, soon. And then you also start making similar calculation for your company, rather two companies. Remember, you have two companies. Your own company, which is Finnair, and the company which you are targeting, KLM. But the basic logic technique will remain same. And what I can do for you, do you know when we have this break? Because we agreed with Jan that we will do it before we go. Next week is the last week before the holidays. Now, I make a small change in the calendar, in my schedule. Next week, when we are in the class, okay, I will not teach you any new topic. But if you have any problem in getting these numbers and doing this calculation, I will be moving around, walking around. And if you have any questions, comments, frustrations, anger, anguish, laughter, joy, that we can share together. Okay? So the next week, no worries. I mean, even after the break, I can cover all these topics which are written in the schedule. No problem. That's not a big deal. At this moment, my very major concern is the project. And by the way, whatever we're learning for the project is also valid for the track itself. So it doesn't matter. So next week, we will not study any new topic, but you will be doing the calculation. I don't want that you start calculation that day. No way. You should have done some homework already when you come next week in the classroom. You will only ask me those things which you are not able to understand conceptually. You say, Shab, we don't know. What is the logic behind this calculation? Or secondly, you are not able to get the information from the financial statements. So it means try to complete this table as much as you can. Rather, remember, for both companies, not just one company. But what I can allow you is that, unlike me, if you want, you can start the calculation from 2015. So you can have shorter time window, but rest everything should be same. So that's it for today. I know last week and this week I've been intellectually very heavy, but you know, in the process we learn important things. That's more important. Okay. If there was no project, I could have followed a different order of topics, but there's always a blessing in disguise when we do something new or complicated. So see you next week. Thank you very much. And thanks, folks. If you have any questions, you can ask me. Otherwise, we shall meet next week. And I hope you heard me saying the students that next week I will not discuss any new topic. You also have any issues with the calculation, problem, you can ask me. But try your best to complete 2 spreadsheets, one for one for Finnair and the second for KLM, and try to put all the input data in the spreadsheet. Sometimes you have to straight away take from the annual report. Sometimes you have to make some estimates. And how I make estimates, you can see, you can get inspired from the spreadsheet which I have shared, GlaxoSmithKline. And in case you are not able to find any data, you can ask me next week, or you can email me during the week or something. Yeah. So there are some chat messages. All right, folks, then we meet next week, yeah? Don't miss out next week because it's very important. Thank you very much, everybody. Yeah. Can we... Sorry?
What is it? On Proxima.
21st of September?
No, this green line.
Ah, is it?
For global financial work.
Oh, it's the level of similarity.
Ah, okay.
Because when you submit your assignment,
Okay.
they go to software called Urkund, which checks the plagiarism if there is any, you know.
And what's the limit?
Well, 2% is very good. So if it is 7, 8, 9, 10%,
Okay. Is that
then it doesn't mean that the person copied. Sometimes I tell you something.
similar? Just
Yeah. Something. For example, I give you the question statement.
Yeah.
I give you a question and then you solve the question and give answer. But when you send me this report, that also include the question.
Okay. Okay.
So then the similarity will go up, but that doesn't mean that you have cheated.
Yeah.
So we decide what is fair, what is unfair. Don't worry about it. No worries. Don't worry about it. That has a point. Well, so what do you want? That I didn't understand you. Do you want me to use the mouse or what? Ah, okay. Bye-bye. Well, that you are, I like your sense of humor. I like humorous people. But I'm sure my boss will be very happy if you give me a present. But my birthday is long way to come. You have to wait because you have to have a reason. Well, how about Christmas present?
Yeah.
But I will not be so amused if somebody presents me a mouse on Christmas Eve. Thank you so much, Dan. Thank you very much. Keeps the happy spirits alive. Okay, and I close the meeting now. So thank you very much, and we all meet next week. Yeah. Have a wonderful rest of the week and the weekend, and do study finance. It's very important for your
See you.
academic health.